Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, last week you may recall we talked about impeachment and Donald Trump getting in a lot of trouble. Now, this week that story is still rumbling on, but the market seemed to move on slightly and took it within its stride. Now, if you're an 80/20 investor member, you will probably know why, because I did some analysis in last week's newsletter which showed how the market had reacted to past presidential impeachments. And so the market took what was going on in US politics in its stride. It's a story that's still ongoing. And the market, the S&P 500 in particular, continue to push up towards its all-time highs once again. Now, this is a market where buy the dip has proved successful for all of 2019, to be honest, and before that. And at the moment, we seem to be getting into the cycle of a fear of missing out, that FOMO. And that seemed to escalate into this week. And if you remember last week's video, I said that what will happen is markets tend to, or at the moment, they seem to be getting caught up in the headlines, this fear of missing out, and every now and then the realities start to creep back in, the fundamentals, which is linked normally towards economic growth around the world. Once that starts to creep in and we get concerns about that, the fundamentals take hold and people become scared. Now, this week we've seen that happen to a greater degree. In fact, we've just seen stock markets hit month lows, particularly in America, and this is now spreading across to Europe and the UK. Now, what's happened is we've had the Purchasing Managers Index, which is called the PMI, and what this does, in very loose terms, is give an indication of trends of economic growth potentially in different areas around the world. So we had the PMI numbers. It's a number that's published where above 50 is showing growth, below 50 is contraction. And what we've seen is around Europe, so we had poor numbers in Germany, we had poor numbers in Italy, in France. In fact, in Germany and Italy, we had contraction, so that number was below 50. Then in America, almost immediately, we had some economic data. So the manufacturing data, the PMIs, were poor. They were some of the worst we'd seen in years. And in the UK, although there was a positive headline that it wasn't as bad as people feared, it was still below 50, i.e. contraction. So the market has now panicked about the likelihood of a recession. Although they had previously started to negate that possibility, thought it was a less likely possibility, now they've decided that it's an increasing likelihood once again. So they're starting to focus on the fundamentals. So the market has now sold off. And if you remember that rotation I talked about that happened between August and September, so the defensives did well in August when everybody was concerned about recessionary environments. That was the defensives doing well, that's REITs, that's utilities doing well, and this is the equity space. If you look at the bond markets, they were doing well, particularly 10-year US Treasury, so longer term bonds were doing well. We had the same in gilt. That rotation unwound in September when people started to think that a recession was less likely. So that pattern has now unwound. By that I mean we've gone back to where we were in August, really. So this week we've started to see the defensives do well again, all those sectors I just mentioned, and we saw bond yields crash. In particular, we saw the 10-year US Treasury yield collapse in the last couple of days. Do you remember we were right up by 1.73, 1.79. We've now gone right the way down towards 1.6 and beyond. So we've seen that replicated in the UK gilt market. So the wobble in equities has obviously been exaggerated slightly because if you remember, I said it was the end of a quarter. So you get a lot of change happening anyway. Over in China, it's what they call Golden Week. So basically it's a week-long holiday where the stock market is closed. So we've got a bit more volatility going on anyway because of these things that are happening in the background. So equity investors are left thinking, where is this headed next? Now, I did a whole technical analysis piece for 80/20 investor members this week where I looked at lines of support and resistance on key investment markets. So that was the UK stock market, the US stock market, the Japanese stock market, and I also looked at the pound versus the dollar exchange rate. And so looked at the possible outcomes, where we could go higher, what levels of resistance would we need to break through, and if we were going to break lower, what levels of support we need to go through. Now, already today, we've seen the S&P 500 fall again for the second day in a row. We're starting to break below the 2,900 level. We're testing that. That's a crucial level. We could be headed back into that trading range we were in previously. We got stuck in a 100-point range between about 2,850 to 2,940. Now, if we enter that, we want to see if we can bounce off support to be able to regain the heights that we've had recently, and maybe an all-time high. Ominously, we've been hitting lower highs, but if we don't rebound and head towards those all-time highs, we have to look to see what could happen next. So we could end up going lower. 80/20 investor members will need to look at the key levels that I pointed out, but for those of you who aren't members, do keep an eye on that 2,840 level. Now, on the FTSE 100, we broke through the 200-day moving average, which is a support line, which has proved very strong of late, and we crashed through that, and understandably we then went on to fall more than 2% today. So now we need to keep an eye on the 7,100 level for the FTSE 100. If we're going to capture those highs again and push higher, we are going to need to get back above 7,350 on the FTSE 100, which seems to be a key support and resistance line. Once we get above that, we tend to push on towards 7,500 inevitably. But at the moment, there's some very strong signs of weakness in equity markets. We've got to see how that unravels in the coming days and weeks. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com. You can contact me via Twitter, moneytothemasses with a number 2, and of course subscribe to our YouTube channel. Until next week.